Welcome to the Deep Dive. We're the show that digs into sources, research, articles, you name it, and we pull out the key insights, the actionable stuff, just for you.
That's right.
And today, we are tackling a giant, a real cornerstone of financial thinking. Benjamin Graham's The Intelligent Investor.
Oh, yeah, absolutely essential reading. I mean, people call it the value investing Bible, and not lightly.
Right, and Warren Buffett himself, talk about an endorsement, called it by far the best book on investing ever written. That's huge.
It really is. You have to pay attention when someone like Buffett says that.
Definitely. So our mission here today is to unpack that. What's the core wisdom? Who are these different investor types Graham talks about? And, what are those timeless ideas that make it so crucial?
We want to make this complex stuff feel genuinely useful for you.
Exactly. So where do we even begin? What's the foundation Graham builds this all on?
Well, Graham's whole philosophy, it really rests on three, let's call them pillars, really powerful ideas. They're not just tips, they're like a whole mindset shift.
Okay, pillar one. This is the famous one, right? Mr. Market. Graham's big insight here seems to be, your emotions are the real enemy, not the market itself.
Precisely. It's such a brilliant allegory.
So the idea is, imagine you have this business partner, Mr. Market, and he shows up every single day. Every day he wants to buy your share of the business or sell you his share.
Right. He gives you a price no matter what.
But the key is, this guy, Mr. Market, is completely manic depressive.
Yeah.
Like clinically bipolar almost.
Exactly. Some days he's wildly optimistic, euphoric even, sees nothing but blue skies ahead, quotes you a ridiculously high price.
And then other days.
Other days he's utterly convinced the world is ending. Total despair. And he'll offer you his shares for, pennies on the dollar.
And his price has nothing to do with the actual business.
Nothing. It's pure emotion. His mood swings dictate the price, not the underlying reality of the company. He's just reflecting the crowd's sentiment.
Okay, so the intelligent investor's move is what?
Yeah, ignore him. Well, you can ignore him. That's the crucial part. You are under zero obligation to trade with him just because he shows up shouting a price.
So the power shift happens there.
Exactly. Your edge comes from using his irrationality. When he's pessimistic and offers a silly low price, way below what you think the business is actually worth based on your own homework.
You buy.
You buy. And when he's euphoric, offering a crazy high price,
You consider selling.
you consider selling. It forces you to be disciplined, detached, to rely on your own judgment, not his mood swings.
That's powerful. We've seen that play out, haven't we?
Oh, absolutely. Think about the dot-com bubble back in 2000. Pure euphoria, prices totally detached from reality. Mr. Market was ecstatic.
And then 2008.
Total opposite. Abject terror. Mr. Market was convinced everything was worthless. The intelligent investor saw both extremes as, opportunities, not signals to panic or get greedy.
Okay, so Mr. Market teaches emotional control. What's the next pillar? You mentioned it protects against,
Yeah.
us.
Hmm.
Our own mistakes.
That's the margin of safety. Graham called it the central concept of investment.
Margin of safety. Okay.
The insight here is profound. Investing isn't about predicting the future perfectly. It's about building in protection. Because you can't predict the future. It's your buffer.
A buffer against what will run. Being wrong, market craziness.
Both. It protects you from your own analytical errors. Maybe you valued the company slightly wrong, and it protects you from that Mr. Market irrationality we just talked about.
So how does it work in practice? Is it just like buying cheap?
Essentially, yes. It means buying a stock only when it's trading at a significant discount to its intrinsic value that you've carefully calculated.
Give me an example. Like if I figure a company's worth $100 a share.
You don't buy it at $95 or even $90. You wait. You wait until Mr. Market, in one of his gloomy moods, offers it to you for, say, $60 or maybe even $50.
Wow, okay. That difference, the $40 or $50 gap.
That's your margin of safety. It's critical because even if your $100 valuation was a bit optimistic, or if the company hits some unexpected trouble, you're less likely to lose money permanently.
Because you bought it so cheap to begin with.
Exactly. Graham had this amazing quote, "The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future." Think about that. It takes the pressure off being perfectly right.
That is kind of liberating, actually. So where does this margin come from? Just low price?
It can come from different places. Often it's about earnings power buying at a low price to earnings, or PE ratio, meaning you're not paying too much for the company's profits.
Makes sense.
Or, sometimes more conservatively, it comes from asset value. This is where you get into things like net investing.
Oh, man, what's that?
That's buying a company for less than its net current assets, basically less than its working capital. Like the
Okay.
cash and receivables minus all liabilities. It's an extreme form of value, buying a company for potentially less than liquidation value.
Sounds hard to find.
Increasingly so, yes, especially in today's markets. But it illustrates the principle.
Okay, emotional control via Mr. Market, protection via margin of safety. What's the third pillar? You mentioned a distinction.
Right. Graham draws a very, very sharp line between investing and speculating. This is crucial.
What's his definition? Because people use those terms pretty loosely.
Graham doesn't. He's incredibly strict. For him, an investment operation is, and I quote, one which, upon thorough analysis, promises safety of principal and an adequate return.
Thorough analysis, safety of principal, adequate return. 3 keys.
Exactly. If your operation doesn't meet all 3 of those criteria, then by definition,
It's speculation.
it's speculation. Simple as that.
Wow, that's a high bar for investing. Does he think speculation is always bad?
Not necessarily evil, no. He acknowledges intelligent speculation. But, and this is a big but, you must know that's what you're doing. Recognize it.
And handle it differently.
Absolutely. Keep it totally separate from your investment capital. Only use money you can genuinely afford to lose entirely. A small part of your overall picture.
Because the real danger is.
The real danger is fooling yourself. Thinking you're investing, following all the prudent rules, when actually you're just gambling, speculating. That's how people get wiped out.
Okay, those 3 pillars, Mr. Market, margin of safety, investor versus speculator, feel like the bedrock. How does he build on that? Does he talk about how to actually invest?
He does. He recognizes that people have different temperaments, different amounts of time and energy. So he outlines 2 main approaches, 2 types of investors.
The defensive and the enterprising.
Exactly. First, the defensive or passive investor, their main goal. Pretty simple. Avoid big mistakes, avoid losses. They also want freedom from, constant effort, worry, and decision-making.
Sounds appealing. What's their strategy?
Keep it simple. Maintain a balanced portfolio. The classic recommendation is maybe 50-50 between high-quality bonds and a diverse group of major stocks.
50-50. Okay. Can they adjust that?
Yeah, he suggests maybe shifting that balance perhaps between 25% and 75% stocks, depending on how you view the overall market levels. But simplicity and balance are key.
And for the stock part,
Yep.
Does he give guidelines?
Oh, yes, very clear ones. For the defensive investor, he says stick to large, prominent companies. Adequate size.
Big names. Okay.
Strong financial condition, low debt is important. A history of consistent profitability, so positive earnings for at least 10 years.
10 years. Wow.
And dividends. Uninterrupted dividend payments for ideally the last 20 years.
20 years of dividends. Okay, what else? Price.
Moderate price multiples. He suggested looking for a price-to-earnings ratio, the PE, of no more than maybe 15 to 20 times the average earnings over the past few years. Don't overpay for profits.
Right.
And also a moderate price-to-book ratio, maybe no more than 1.5 times book value. So you're not paying way over the odds for the company's net assets on paper.
Okay, so that's the defensive path. Simple, safe, low effort. What about the other type? The enterprising investor.
The enterprising or active investor. This path is, different. It requires serious time commitment, real intellectual effort.
Why? What's the goal?
The goal is potentially beating the market averages, earning returns that are better than what the defensive investor or just an index fund might achieve.
So it demands more skill.
Skill and diligence, yes. You're actively hunting for value that the general market has missed. You need to put in the work.
Where did Graham suggest these enterprising investors should look? What kind of hunting ground?
He pointed to a few areas. One was buying in generally depressed markets. Basically, take advantage of bear markets when everyone else is panicking, scoop up quality companies when they're cheap.
Classic contrarianism. Makes sense. What else?
Buying specific bargain issues. These are stocks that meet really strict criteria for being undervalued, like those nets we mentioned earlier, companies trading for less than their working capital.
Still very focused on deep value.
Very much so. And the third area was what he called special situations or workout.
Special situations, like what?
Think companies going through big changes. Mergers, acquisitions, spin-offs, liquidations, reorganizations, stuff like that.
Finding value in corporate actions.
Exactly. Where the outcome is reasonably predictable if you do the analysis, and the potential return is attractive relative to the risk and the time involved. It's complex work, requires real expertise.
Okay, so 2 distinct paths, depending on your goals and willingness to put in the effort. That's helpful. Let's talk about the book itself. How is it put together?
It's very methodical, very Graham. The early chapters really lay down that philosophy we've been discussing, Mr. Market, margin of safety, depth thinking.
And later parts?
Then it gets more into the nitty-gritty of security analysis, comparing stocks and bonds, portfolio policy, how to actually apply the philosophy.
Are there chapters people should particularly focus on?
Absolutely. Graham himself, and Buffett echoes this, really highlights Chapter 8, which is all about the investor and market fluctuations. That's the Mr. Market chapter.
Got it.
And Chapter 20, which is called Margin of Safety as the central concept of investment. If you read nothing else, read those two. They contain the essence.
Good tip.
Hmm?
Now, modern editions have commentary by Jason Zweig, right? How important is that?
Oh, it's incredibly valuable. Zweig is a fantastic financial journalist, and what he does is brilliant. He takes Graham's concepts, which were written mid-20th century.
Right, the examples must feel dated sometimes.
Exactly. Zweig translates them. He uses modern examples, the tech bubble crash, the 2008 crisis, to show how Graham's principles are just as relevant, maybe even more relevant today. He bridges the gap beautifully.
So that really underscores the book's timelessness.
Completely. I mean, think about today's world. 247 financial news cycles, meme stocks going crazy, crypto volatility. It's noisy.
Understatement of the year.
Right. Graham's lessons on psychology, on risk, on discipline, they're like an anchor, a logical framework in this sometimes chaotic sea of information overload.
It's like a filter for the noise.
A very powerful filter.
Okay, but nothing's perfect. Are there criticisms of Graham's approach in today's world? Does it all still hold up?
That's a fair question, and yes, there are thoughtful critiques. One common point is about his heavy focus on tangible assets, like book value.
Why is that a critique?
Well, think about many of the biggest, most successful companies today. Tech companies, service companies. Their value isn't primarily in factories or inventory.
It's in intangible stuff like patents, brand recognition, network effects.
Exactly. Things like Google's search algorithm or Microsoft's software ecosystem, applying a strict Graham-style, low price-to-book value screen might cause you to miss out on those kinds of businesses entirely. Valuing intangibles is just harder using his original metrics.
That makes sense.
What else?
Another point is market efficiency. The argument goes that markets today, especially in the U.S., are much more efficient than in Graham's time. There's more information, more analysts.
So those super obvious bargain issues or net nets are harder to find. Much harder. They still exist occasionally, but you have to dig deeper, maybe look in less followed corners of the market. The easy pickings are largely gone.
Any other major critiques?
The global aspect. Graham's book is primarily focused on the U.S. market. Today, investing is truly global, much more interconnected. That adds layers of complexity, currency risk, political risk, different accounting standards that the original book doesn't delve into as much.
Right. The world is definitely more complex now.
No doubt.
So pulling all this together, if someone picks up The Intelligent Investor today, what's the real takeaway? What should they expect?
Well, first, what not to expect. It's definitely not a get-rich-quick guide. It's not a step-by-step formula for instant market-beating returns.
Not a treasure map to billions.
Not at all. Its real value is much deeper. It's a philosophical guide. It teaches you how to be a resilient, business-like investor, how to think rationally about markets.
So it's more about the mindset than specific stock picks.
Absolutely. It's an education in financial history, in how businesses are valued, and maybe most importantly, in understanding your own psychology and the psychology of the crowd. It teaches you how to think, not what to think.
Providing that sound intellectual framework for a lifetime of investing, as they say.
Precisely. It's about building good habits of thought and analysis.
Okay, so let's leave our listeners with something to chew on. We've got this timeless wisdom from Graham, these core principles. We also have these valid modern critiques, the changing nature of value, market efficiency, globalization.
Right. The landscape has shifted.
So the question for you, the listener, is this. How might an intelligent investor today, acknowledging both Graham's genius and the realities of the 21st century, uniquely adapt these principles? How do you find your margin of safety in these complex, global, digitally driven markets?
That's the challenge, isn't it? Applying timeless wisdom to ever-changing conditions.
Something to really think about.